We're joined now by Saurabh Mukherjea, who's the founder and CIO of Marcellus Investment Manager. Saurabh, as always, thanks so much for taking the time and good morning to you. I wonder how much attention you're paying to everything that is coming from the White House and from Donald Trump's Truth Social account, because that seems to be where the news breaks nowadays in the United States. And there's quite a bit of pressure tactics seemingly on India to sign a trade deal.
Yeah, I think this must be a precedent to sort of tailor-made for journalism. I have to say, for financial journalism, there's always every day something for you guys to discuss. I think like everybody else on your channel, I'll agree
That
with
and
you.
comedy, Saurabh.
Yeah, so I mean, you can't ask for a better package, right? Drama and comedy together every morning for the global financial audience. But in all seriousness, this does look like brinkmanship. What struck me was the fact that it's come less than 24 hours before the deadline. So it's very interesting that he made this announcement 24 hours before his own self-imposed 31st July deadline. And that's what I think makes it so clear that this is a pressure tactic. My reckoning is in the next couple of months, India and America will crack a deal. We will end up, I strongly suspect India will end up with tariffs better than the 25% angle. I think Parag Bhai mentioned the Russia angle, and it's pretty clear that Trump is using this as a way to browbeat India into reducing its purchase of Russian oil. I'm not so sure that will succeed. I think India quite rightly buys Russian oil because it's cheaper than the stuff available from elsewhere in the world. So it's not something we'll do a lot of trading around. If some of the companies that we like, for example, Divi's Lab has been a big holding for many years. If that comes off dramatically, we'll buy some more of it. But I don't see anybody in the right mind deciding to sell high quality names like Divi's Lab on the back of this. In any case, I think IT, pharma, electronics, I think will be exempt. Even if this 25% tariff were to go through, it's high chances that the three big Indian exports to America, pharma, electronics, and IT will be completely exempt from this. So you're largely focusing on small pockets of pain such as textiles and auto. And whilst we have some exposure there, for example, we are shareholders in Sona Comstar. Again, if Sona Comstar comes off dramatically on the back of an announcement like today, we'll think of buying. So it's not a sell trigger for us by any stretch of the imagination. It's par for the course. We've all got accustomed to this. In fact, our global compounder strategy actively looks to buy on the back of the American president's tariff threats. We bought heavily through April when Liberation Day was announced. American stocks came off. We bought American stocks heavily through April and are sitting pretty on those gains through May, June, July. So Taco, Trump always chickens out as a well-established trade in America. I suspect will soon become a well-established trade in India.
Saurabh, hi. Good morning. Yes, this is a lot of, I would say, fun in heavily quoted terms for financial journalists because Trump is keeping us on our toes. What's on this buy list? What's on this tariff hit buy list? Would any of them, for example, textile companies make it to that list? Would it be pharma companies? What do you think is the right way to make the most of what could end up being a taco trade?
So look, I think it is very clear that America needs India on two fronts, right? America needs India to reduce its dependence on China for electronics, Apple being the star play there. And America needs India to reduce its dependence on China for active pharmaceutical ingredients. Remember, China still supplies 70-80% of America's API. India supplies the remaining 20-30%. So America clearly wants to diversify away from China in those two areas. It's not evident to me that countries like Vietnam are beyond a point credible alternatives to India, right? So there is a big China plus one trade there. America knows that. America knows that India wants to step into China's big shoes in electronics and pharma/API, and therefore they're leveraging that to say, let American agricultural produce and dairy and poultry produce into India, and that's where, as we all know, is the stumbling block. So my reading is there will be a deal that will get done over the next couple of months, and therefore we are resolutely positioned in companies that can play the pharma API play. So Divi's Lab is a big holding for us. In our small cap portfolios, we also have a company which used to be called Ami Organics. It's now called Acuitas. I don't quite know how to pronounce it. ACUTAS. So in our small cap portfolio, we have that. The electronics piece, we have not yet been able to make purchases, right? Clearly, Dixon's is the star play there, but it's eluded us. It's an electronic manufacturing services play has eluded us. We continue to do more work, and if, courtesy Mr. Trump, the EMS plays become cheaper, if Dixon tanks, then so much the better. We will think of looking at EMS. There's plenty of good companies in that space. We'll think of looking at buying one. But these are two big trades. I think they will become big parts of the Indian market, EMS and API. These will become big parts of the Indian market in the years to come. And I think the trade deal will eventually get done.
By the way, the markets are steady at that 0.5% downtake. So bear that in mind, with banks also now kind of putting that little bit of pressure, 0.5%, more than 0.5% now for the Nifty Bank as well. Saurabh, there is a fair degree of chatter around how in these uncertain times, and God knows this is only the first 6 months, the next 3.5 years also promise to be uncertain, that it might be better to focus a lot on domestic plays as well. So if you're looking at pharma, could people look at domestic CDM or a domestic foremost players, or some of the other buckets which are largely insulated from the global uncertainty? Would that be a good way to approach the portfolio construct right now?
So I think yes and no, in the sense that even if you were to look at domestic, I think we are an economy which has, leaving aside America, we have other strong linkages with the global economy. So it's difficult to say that let's completely leave the world aside and focus on India alone, because it doesn't work like that. And in any case, even if we were to focus on domestic stocks, the domestic economy is not in the greatest of shape, right? If one were to say, let's forget the world outside, focus on India only, I would say domestic capital goods companies would be the area of interest. That's an area we're looking at carefully. My reading is we're in a domestic consumption downturn, which will last for a few quarters yet. I think the job situation is fragile, and that's leading to an extended downturn in consumption. I think domestic consumption rates or savings rates will have to go up, which means consumption will come off, I think, in the next few quarters, if not the few years. And therefore, if one is to focus on India, then domestic capital goods plays would be the place to look at. Corporate India, as we know, for the first time in its history, corporate India has net cash, right? And that net cash will get expended. That will get expended as the capex cycle begins. I think L&T's results 2 days ago were heartening in that regard, because L&T announced a big thermal power order, BTG order from a domestic power generator. I hope that sort of triggers the beginning of a private sector capex boom in our country.
Speaking of results, since you mentioned Larsen & Toubro, Saurabh, I'm just wondering, we've got most large companies that have posted already. What is the scorecard looking like for you? Is it more disappointing than anything else? Of course, there are pockets. There are pockets that are bright. Larsen & Toubro is one of them. But are you more disappointed than not?
No, I think we've been expecting this. By and large, for the last 4 results, we've been able to grow EPS in our portfolio by around 10-11%, whereas Nifty EPS growth has been around the 4-5% mark, right? So courtesy the strength of our franchises, e.g., I'll just give a simple example, HDFC Bank, right? As the rest of the banking and NBFC sector copes with asset quality stress, it's HDFC Bank's champion credentials on underwriting are coming through, and this is exactly what I've seen in market cycles, right? When there is euphoria, then nobody wants to buy thoroughbreds like HDFC Bank. People would rather buy a third-rate lender which looks optically cheaper, and then inevitably, when the economy slows down, that's when the thoroughbreds credentials come to the fore. An HDFC Bank is able to chug out EPS growth, or a Divi's Lab is able to chug out EPS growth, or a Pidilite is able to chug out growth in difficult markets, in difficult economic circumstances, and therefore quality reasserts itself. So I think the quality reassertion trade is very much back on in India in the last, especially the last 2 quarters. And given geopolitics, given the domestic consumption downturn, I think the quality trade will stay on for the next few quarters. And I can't but cheer that, right? That's been our style of investing. Our style of investing took a backseat in the euphoric years after COVID. That's when people migrated to value. But as euphoria subsides, quality is coming back.
Okay. Saurabh, just a couple of more minutes with you, please. I want to introduce Vikas Khemani also to this conversation that we're having this morning. It's an important one to temper the concerns that you're seeing in the market. And the concerns are valid because it's feeling like a bit of betrayal, for a better word. Vikas Khemani, I want to know what your thoughts are. We spent an inordinate amount of time trying to hammer out a deal and then to summarily just, be handed over some formula and then the back and forth on it. Do you think that the weakness we're seeing in the markets right now is an opportunity or it could get worse?